Welcome to the March 28th, 2021 Advance Report for McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman and president, McGowan Group Asset Management, serving clients, business leaders, and investors from the Crescent right here in Dallas. Today's fast-paced financial tour of the global financial markets is actually I'm going to start with the Dow Jones Industrial Average. We often start here, but I want to point something out about the Dow. See this right here? That spring wilting was about 1,000 points, by the way, from an all-time high above 33,200 back down. And I'm going to show you some valuation metrics that are important through 2021 when you just look at the overall equity markets. But you can see the recovery from the spring wilting. What was the corresponding set of news stories? That's something we cover at NetWorthRadio.com. What are the news stories? What do they mean? Well, Europe started lockdowns again. And everybody was scratching their head saying, wait a second, U.S. cases coming down like this. Well, we found the data that tells us what was going on. European vaccines, only 11% of Europeans have been vaccinated versus almost 30% now for the U.S. They botched their vaccine rollout. Temporarily, they're shut down. Eventually, they'll probably get it right. But the bureaucracy in Europe versus Operation Warp Speed in the United States is a severe contrast. And congrats to the U.S. for getting things right so far. Now, that's the recovery. We can see the Dow around 32,700 or so at the end of the week. But is that too far, too fast? What's this? Well, S&P 500, a basket of companies, they're supposed to earn money. This is how much money they earn after tax every single quarter. Notice this. That is October 2018, the last time that earnings were $40 per quarter after tax for this group. After tax is a key word. I'll tell you why in just a second. So then we have the pandemic. Earnings plummet, right? U.S. companies, though, got it right in terms of figuring out how to operate safely and recovering to record profits, but they're not there yet. This earnings report may take us to about right here. That comes out in April. The markets are starting to anticipate that. But we're not even recovered to back there. What's the punchline? The Dow was only 27,000 back then, and they're about to decrease the earnings valuation of the S&P 500 by 10% with a tax increase from 21% to 28%. That's good. That may knock 10% off the value, and we're 20% above where we were when earnings were this much. And we don't get back there until the October announcements, and we don't really get over that until we start to see the fourth quarter of 2021. So, maybe too far, too fast. But look at this. This is a very optimistic projection. It's proved to be optimistic in the past. This is Bloomberg and all the analysts' input to a database. But it says, yes, we could reach record highs with distance, this number potentially 20% above where we were in 2018 by the middle of next year. So that we may be range bound for a while. What's happening in the economy? Good news this week. We just ran this thanks to Super Chuck Norris, Stephen Norris here, one of the relationship managers in McGowan Group. He also does your allocations. If we apply a model trade to all the portfolios, he makes sure no clients left behind, no dollar left behind. 7% GDP growth for this quarter and next quarter, right? So that's what's been projected for Q2, Q3. Well, they're comparing against, of course, the shutdown quarters. Then it levels off to about 2.5% growth. Record employment, probably somewhere near the end of 2022, according to this graph. Higher taxes and more regulation likely to pull that GDP number longer term down to like 1%, which was the recovery that we saw 2008-9 through 2016. Now, interest rates and the impact on bonds. This is a quick bond lesson for where the globe is and what happens in a rate spike. And where would you want to be on your fixed income if rates spike? Cash is one answer, but I'm going to give you another answer as well with some evidence here. Okay, this is all the countries, the major countries, and the U.S. right now, 1 2/3% on a 10-year treasury. These are all the 10 years. But I want to point something out here. We just had a rate spike, and the low on the 10-year treasury was actually 1/3% during the pandemic. Absolute panic, right? There's duration risk. When the interest rates rise, I'm about to show you what duration risk does to the value of a longer-term treasury. So you heard about rate spike and inflation. It may be not so fast. In other words, it's not here in a massive way yet. And of course, people say, well, it's too late then. Brazil's 10-year is 4%. What's this? Negative interest rates in the Netherlands and Switzerland. Okay, that's not, Switzerland, people pay money to keep their money there, right? Germany, minus 1/3%, right? So European interest rates, France is actually negative. You have to pay money to own a French bond. Doesn't seem like a good idea, especially for 10 years. But in any case, if we go to parity with them early next year because of any economic disappointment or even a crisis, well, there is a forecast that our rate could go as low as 0.5%. So you're looking at this on the interest rate picture with predictions on both sides. Now, what do you do about it? This is not what you do. This is the price of a 20-year treasury down 13%. So if you put your money in, let's say the Vanguard Long-Term Government Securities Fund, boom, you're off about 13% so far this year because of that rate spike I just talked about. What was a better place to be? Well, this is a year-to-date performance. It's kind of the exact opposite, I'll point out. And this is one of the better high-yield choices, in my opinion. Not a recommendation for your portfolio till you come down and get a plan. But the high-yield index here in the U.S. is about a break-even so far this year instead of a disastrous decline. The Vanguard total bond market is a minus 4% in price and a 2% yield. Well, what that tells you is there's a better place to be usually in fixed income. There's cash, there's floating rates, and high yield. High yield's more volatile when the stock market tanks and everybody's scared. That's when you can pick up bargains there. But in this case, we're still looking at high yield being a favored category for at least another year to 18 months. Now, this is oil, right? You can see it spiked to 68. Whoa, what's that right there? That's a decline to below 58. That was the European lockdowns sending everybody back into COVID-19 temporary panic. The spring wilting, we called it in this week's program. Well, longer term, oil between 50 and 70, and I'm drawing a wide range, is realistic because demand is being restored. Air travel is over half restored to 2019 levels, and on good days it's about 2/3 restored, with lots of airlines gearing up for travel this summer. And if you're going to travel, you probably need to book your trip because there's a whole bunch of people that just got vaccinated and they're ready to travel. Good news for the U.S. I'm Spencer McGowan, President, McGowan Group, NetWorthRadio.com. Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President, McGowan Group, your financial weatherman. We sponsor each week NetWorthRadio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as NetWorthRadio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to networthradio.com, themcgowangroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors and exactly how our clients have done, disclosed right here. Further disclosures, value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast, and that can actually work to your advantage. We'll build that into your plan. So I urge you to go to networthradio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast or any securities doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.